Section 4.1, 4.3 Understanding the Efficient Frontier, Section 4, Benefits and Applications of the Efficient Frontier, 4.1 Risk Diversification, Exploring the Benefits of Diversification in Portfolio Construction. Diversification is a fundamental principle in portfolio construction that offers several benefits to investors. Here are some key benefits of diversification. Risk reduction. Diversification helps to reduce the overall risk of a portfolio. By investing in a mix of different assets that are not perfectly correlated, the impact of individual asset price movements on the portfolio is mitigated. When one asset or sector underperforms, the potential losses can be offset by the positive performance of other assets, thereby reducing the overall volatility and downside risk. Smoother returns. Diversification can lead to smoother and more stable portfolio returns over time. By spreading investments across different asset classes, sectors, and geographies, investors can balance the impact of market fluctuations. This can help to avoid significant losses during periods of market downturns and create more consistent returns. Improved risk-return trade-off. Diversification allows investors to achieve a better risk-return trade-off. By combining assets with different risk and return profiles, investors can target a desired level of return while managing the level of risk they are willing to take. Diversification enables investors to potentially increase returns without a proportionate increase in risk, or reduce risk without sacrificing returns. Potential for higher returns. Diversification can also enhance the potential for higher returns. By investing in a diversified portfolio, investors have exposure to a wider range of investment opportunities. If some investments outperform, the overall portfolio can benefit from the positive performance. Diversification allows investors to capture returns from different asset classes and take advantage of market opportunities. Preservation of capital. Diversification helps to preserve capital by reducing the impact of significant losses. By avoiding overconcentration in a single investment or asset class, investors can minimize the risk of losing a substantial portion of their capital if a particular investment performs poorly. Diversification provides a level of protection and helps to safeguard the long-term value of the portfolio. Adaptability to changing market conditions. Diversified portfolios are generally more adaptable to changing market conditions. Different asset classes and investments may perform differently under various economic or market scenarios. Diversification allows investors to adjust their portfolios to capture potential opportunities or mitigate risks as market conditions evolve. Psychological benefits. Diversification can also offer psychological benefits to investors. By diversifying their portfolios, investors may experience reduced stress and anxiety associated with relying heavily on a single investment or asset. Diversification provides a sense of security and peace of mind, knowing that the impact of any single investment's performance is limited. It's important to note that diversification does not guarantee profits or protect against losses, and it is still subject to market risks. However, it is widely recognized as a prudent strategy to manage risk and enhance long-term investment outcomes. By combining different assets with uncorrelated or low correlation, investors can potentially achieve a more stable and optimal investment portfolio. Understanding how the efficient frontier helps identify optimal diversification strategies. The efficient frontier plays a crucial role in identifying optimal diversification strategies by highlighting the combinations of assets that offer the highest expected returns for a given level of risk. Here's how the efficient frontier helps in identifying optimal diversification strategies. Risk-return trade-off. The efficient frontier represents a set of portfolios that maximize expected return for a given level of risk or minimize risk for a given level of expected return. It shows the different combinations of asset allocations that achieve the most efficient trade-off between risk and return. By plotting various portfolios on the efficient frontier, investors can visually see the range of possible risk-return combinations. Portfolio optimization. The efficient frontier serves as a guide for portfolio optimization. Investors can use mathematical optimization techniques, such as mean variance optimization, to identify the optimal asset allocation that lies on the efficient frontier. This optimization process considers the risk and return characteristics of each asset and determines the combination that provides the highest expected return for the desired level of risk or the lowest risk for the desired level of expected return. Diversification benefits. The Efficient Frontier highlights the benefits of diversification. It demonstrates that by combining assets with different risk and return profiles, investors can achieve higher returns or lower risk compared to individual assets. Portfolios on the Efficient Frontier typically contain a mix of assets from different asset classes, sectors, geographies, or investment styles. Diversification helps to reduce the overall risk of the portfolio and enhance the risk-adjusted returns. Identifying optimal diversification. The Efficient Frontier assists in identifying optimal diversification strategies by showing the portfolios that provide the highest level of expected return for a given level of risk. Portfolios that lie on the upper portion of the Efficient Frontier represent optimal diversification strategies that maximize returns. Investors can choose an asset allocation that suits their risk tolerance and investment objectives by selecting a portfolio along the Efficient Frontier. Evaluation of diversification strategies. The Efficient Frontier allows investors to compare different diversification strategies. It provides a benchmark to evaluate the risk and return characteristics of portfolios and assess their performance relative to the optimal diversification strategy. Portfolios that lie below the Efficient Frontier are considered suboptimal in terms of risk-return trade-off, indicating that better diversification strategies are available. Dynamic portfolio adjustments. The Efficient Frontier is not static and can shift over time due to changes in asset prices, correlations, or risk-free rates. It helps investors make dynamic adjustments to their portfolios based on changing market conditions. By monitoring the position of their portfolios relative to the Efficient Frontier, investors can identify opportunities for rebalancing or adjusting asset allocations to maintain optimal diversification. In summary, the Efficient Frontier provides a framework for identifying optimal diversification strategies by visualizing the trade-off between risk and return. It helps investors understand the benefits of diversification, optimize their portfolios, and make informed decisions to achieve their desired risk-return objectives. 4.2 Portfolio Optimization and Asset Allocation. Utilizing the Efficient Frontier to determine the optimal asset allocation for a given risk tolerance. To determine the optimal asset allocation for a given risk tolerance using the Efficient Frontier, follow these steps. Assess risk tolerance. Determine your risk tolerance as an investor. This is an individual's willingness and ability to take on risk. Consider factors such as investment objectives, time horizon, financial goals, and personal preferences. Understand the Efficient Frontier. Familiarize yourself with the concept of the Efficient Frontier, which represents the set of portfolios that provide the highest expected returns for each level of risk. The Efficient Frontier illustrates the trade-off between risk and return and helps identify optimal asset allocations. Evaluate risk-return preferences. Consider your desired level of risk and return. Determine the target risk and return levels that align with your risk tolerance. This will help you narrow down the range of portfolios on the Efficient Frontier that are suitable for your risk-return preferences. Review risk-reward trade-off. Analyze the risk and return characteristics of the portfolios on the Efficient Frontier. Evaluate how the portfolios vary in terms of risk, as measured by standard deviation or another appropriate risk measure, and expected returns. Assess the trade-off between risk and return to identify portfolios that offer the desired risk-return profile. Optimize asset allocation. Use portfolio optimization techniques, such as mean variance optimization, to determine the specific asset allocation that maximizes your risk-adjusted returns. The optimization process aims to find the portfolio on the Efficient Frontier that aligns with your risk tolerance and provides the highest expected return for the desired level of risk. Consider diversification. Take into account the benefits of diversification by allocating your investments across different asset classes, sectors, or geographies. Diversification helps reduce risk and enhance risk-adjusted returns. Ensure that your asset allocation is well diversified to mitigate concentration risk and capture potential opportunities from different market segments. Monitor and rebalance. Regularly review and monitor your portfolio's position relative to the Efficient Frontier. Over time, asset prices, correlations, and risk preferences may change, impacting the optimal asset allocation. Periodically rebalance your portfolio to maintain the desired asset allocation and risk-return characteristics. Seek professional advice. consider consulting with a financial advisor or investment professional to assist you in determining the optimal asset allocation for your risk tolerance. They can provide insights, conduct sophisticated analyses, and help tailor the asset allocation to your specific financial situation and goals. Remember that the optimal asset allocation is specific to each individual's risk tolerance and investment objectives. By utilizing the efficient frontier and considering your risk tolerance, return expectations, and diversification benefits, you can determine an asset allocation that aligns with your risk-return preferences and supports your long-term investment goals. User, considering different investment objectives and constraints in portfolio optimization. When conducting portfolio optimization, it is essential to consider various investment objectives and constraints to develop a well-rounded and tailored portfolio. Here are some common investment objectives and constraints to take into account. Return objective. Determine the target level of return you aim to achieve from your portfolio. This objective may be based on financial goals, such as retirement planning or wealth accumulation. Risk tolerance. Assess your risk tolerance, which reflects your willingness and ability to bear investment risk. It influences the level of volatility and potential losses you are comfortable with. The asset allocation and risk levels of the portfolio should align with your risk tolerance. Time horizon. Consider your investment time horizon, which refers to the length of time you plan to invest before needing to access the funds. Longer time horizons generally allow for a higher tolerance for volatility and potential for higher returns. Liquidity needs. Evaluate your short-term liquidity needs. If you have immediate cash requirements or anticipate large expenses in the near future, you may need to allocate a portion of your portfolio to liquid assets or short-term investments. Regulatory and legal constraints. Be aware of any regulatory or legal constraints that impact your investment decisions. For example, certain investment vehicles or strategies may be restricted due to regulatory requirements or investment policies. Tax considerations. Take into account the tax implications of your investment decisions. Different investments and strategies may have varying tax consequences, such as capital gains taxes or tax deductions. Consider optimizing your portfolio to minimize tax liabilities while maximizing after-tax returns. Constraints on asset classes or investment vehicles. Identify any constraints related to asset classes or investment vehicles. Some investors may have preferences or restrictions regarding certain asset classes, example, avoiding specific sectors, or investment vehicles, e.g., excluding certain types of funds or derivatives. Ethical or socially responsible investing. If you have specific ethical or socially responsible investment preferences, incorporate them into the portfolio construction process. Consider screening for investments that align with your values or integrating environmental, social, and governance (ESG) factors into the selection criteria. Concentration and diversification. Evaluate the desired level of concentration and diversification in your portfolio. Concentration refers to the allocation of a significant portion of the portfolio to a limited number of investments, while diversification involves spreading investments across different asset classes, sectors, or regions to reduce specific risk exposure. Investment constraints. Take note of any additional investment constraints that are unique to your circumstances, such as cash flow requirements, legal restrictions, or specific investment guidelines you must follow. By considering these investment objectives and constraints, you can construct a portfolio that aligns with your specific needs, preferences, and constraints. The portfolio optimization process can then take these factors into account to develop an optimal asset allocation that aims to achieve your investment goals while adhering to the identified constraints. It is important to regularly review and adjust the portfolio as your objectives and constraints may change over time. Seeking guidance from a financial advisor can provide valuable insights and expertise in navigating these considerations. 4.3 Performance Evaluation and Comparison. User, evaluating portfolio performance against the efficient frontier. To evaluate portfolio performance against the efficient frontier, follow these steps. Determine the benchmark. The efficient frontier serves as a benchmark for evaluating portfolio performance. Identify a specific portfolio or point on the efficient frontier that represents the target risk-return trade-off for your investment strategy. Calculate portfolio performance measures. Calculate various performance measures to assess how your portfolio compares to the benchmark. Common performance measures include return, calculate the portfolio's actual return over a specific period, typically expressed as a percentage. Risk, measure the portfolio's risk using metrics such as standard deviation, variance, or downside deviation. Compare the portfolio's risk level to the risk level of the benchmark portfolio. Risk-adjusted return, evaluate the portfolio's risk-adjusted return by using ratios like the Sharpe ratio or the Trainer ratio. These ratios consider both the portfolio's return and its risk, allowing for a comparison against the benchmark's risk-adjusted return. Tracking error, measure the deviation of the portfolio's returns from the benchmark's returns over time. A lower tracking error indicates a closer alignment with the benchmark. Alpha, calculate the portfolio's alpha, which represents the excess return achieved above or below what would be expected given the level of risk. Positive alpha indicates outperformance, while negative alpha suggests underperformance. Information ratio, assess the portfolio's information ratio, which measures the portfolio manager's ability to generate excess returns relative to the benchmark per unit of active risk taken. Compare performance measures. Compare the calculated performance measures of your portfolio against the benchmark. Evaluate how the portfolio's return, risk-adjusted return, tracking error, alpha, and information ratio compare to the corresponding measures of the benchmark portfolio. Analyze deviations from the efficient frontier. Assess any deviations from the efficient frontier. If your portfolio's risk and return characteristics fall outside the range of the efficient frontier, analyze the reasons behind these deviations. Evaluate whether the deviations are intentional and aligned with your investment strategy or if they indicate potential issues that need attention. Consider long-term performance. Evaluate portfolio performance over the long term rather than relying solely on short-term results. Assess how the portfolio's risk-adjusted returns compare to the benchmark's risk-adjusted returns over multiple market cycles and different economic environments. Identify areas for improvement. Identify areas where your portfolio can be improved to align more closely with the efficient frontier. Consider rebalancing the portfolio, adjusting asset allocations, or incorporating different investment strategies to optimize the risk-return trade-off. Regularly monitor and review. Continuously monitor and review the portfolio's performance against the efficient frontier. Periodically assess whether adjustments are needed to maintain alignment with your investment goals and the desired risk-return profile. Keep in mind that while the efficient frontier provides a useful benchmark for evaluating portfolio performance, it does not guarantee optimal results in all market conditions. Market dynamics, changing risk factors, and evolving investor preferences can impact the position of the efficient frontier over time. Therefore, it is essential to regularly reassess and adjust your portfolio to stay aligned with your investment objectives and changing market conditions. Comparing different portfolios to identify the most efficient ones. When comparing different portfolios to identify the most efficient ones, you can consider the following factors. Risk-return trade-off. Evaluate the risk and return characteristics of each portfolio. Assess how each portfolio's expected return compares to its level of risk. Look for portfolios that offer higher returns for a given level of risk or lower risk for a desired level of return. Diversification. Consider the level of diversification in each portfolio. Evaluate how well the portfolios spread their investments across different asset classes, sectors, or regions. Look for portfolios that effectively diversify risk by avoiding overconcentration in a single asset or asset class. Efficient frontier placement. Compare the position of each portfolio relative to the efficient frontier. Portfolios that lie on or near the efficient frontier are considered more efficient as they provide the highest expected return for a given level of risk or the lowest risk for a given level of expected return. Risk measures. Analyze risk measures such as standard deviation, variance, or downside deviation for each portfolio. Lower risk portfolios are generally preferred, but it's important to assess risk in conjunction with expected returns. Performance metrics. Evaluate performance metrics such as the Sharpe ratio, Trainer ratio, or information ratio for each portfolio. These metrics help assess risk-adjusted returns and the ability of the portfolio to generate excess returns relative to its risk exposure. Consistency. Consider the consistency of performance over time for each portfolio. Evaluate how the portfolios perform across different market cycles and economic conditions. Look for portfolios that demonstrate more stable and consistent performance. Constraints and objectives. take into account any specific constraints or objectives that are important to you. Consider whether the portfolios align with your investment goals, risk tolerance, time horizon, and any specific requirements or preferences you may have. Evaluation period. Assess portfolio performance over an appropriate evaluation period. Short-term performance may be influenced by market volatility and may not reflect the long-term effectiveness of the portfolios. Consider a period that is relevant to your investment horizon and objectives. Sensitivity analysis. Conduct sensitivity analysis to evaluate the impact of changes in key parameters, such as asset returns or correlations, on the performance of each portfolio. This helps understand how the portfolios may respond to different market conditions or assumptions. Professional advice. If needed, seek the guidance of a financial advisor or investment professional who can provide insights, expertise, and quantitative analysis to compare and identify the most efficient portfolios based on your specific needs and preferences. By considering these factors and conducting a comprehensive analysis, you can compare different portfolios and identify the most efficient ones that align with your investment goals, risk tolerance, and constraints. It's important to remember that portfolio selection is subjective and should be tailored to individual circumstances, as different investors may have different preferences and objectives.